What's the biggest secret hidden within the Neo-Tokyo markets? It's not about picking the right corporation. It's about knowing who you are, a hunter or a farmer. A hunter must react in fractions of a second to catch their prize, while a farmer plans for a harvest seasons away. Using the wrong mindset will leave you empty-handed. Let's find out which one you are. Today, we're going to break down the difference between trading and investing in a super simple way. By the end of this transmission, you'll know exactly what each one is, how they work, and which path is the right fit for you. But before we activate the terminals, remember, this video is for educational purposes only. Always conduct your own reconnaissance or consult with certified navigators before risking your resources. Let's break this down, step by step. Let's start with trading. Just like the word suggests, trading means buying and selling. In the Neo-Tokyo markets, trading is all about purchasing corporate shares at a lower price and selling them at a higher price. But here's the key. This all happens in a very short time frame, and traders do this frequently. We're talking hours, days, weeks, or at most, few months. To be an effective trader in these neon streets, you need to master something called technical analysis. Now, what exactly is technical analysis? I'm sure you've seen those complex-looking digital charts with green and red bars on your HUD, right? Those are called candlestick charts, and each candlestick tells a story about price movement. Simply put, when you see a green candle, it means the stock price went up during that period because more people were buying than selling. A red candle? That means the price dropped because more people were selling than buying. Now, candlestick charts are actually way more complex than this basic explanation. But for beginners, this is the core concept. Traders spend hours analyzing these patterns, looking for signals about when prices will drop and when they'll rise again. Technical analysis is based on the idea that history tends to repeat itself. If a certain pattern led to a price increase before, it might do so again. Let me walk you through a realistic trading scenario in the city. Imagine you're watching a tech company called TechFlow Solutions, and you notice its stock chart forming a pattern. Your analysis suggests the stock, currently at 15 units, is about to bounce back up. The golden rule of trading is simple. Buy low, sell high. Most hunters wait for confirmation. They want to see the stock actually starting to rise before jumping in. So you buy 5 shares at 15 units each, spending 75 total. The stock climbs to 19, and your technical analysis shows warning signs that it might drop soon. You sell all 5 shares for 95 units. Congratulations! You just made a 20-unit profit. Your prediction proved correct. The stock falls to 16. You spot another opportunity and buy again. So you buy 5 shares, spending 80. This time, it rises to 23. And you sell at 115, making another 35-unit profit. Now, I know what you're thinking. This sounds like easy money. But hold on, Sherlock. The example I just gave you is every trader's dream scenario. Reality. It's much harsher down in the lower city. Technical analysis is never 100% accurate. You're essentially trying to predict the future based on past patterns. What if you buy at 15, expecting it to rise, but instead, it keeps falling to 12, then 10, then 8? This is where traders use a safety net called a stop loss. A stop loss is like an emergency exit. You decide in advance the maximum loss you're willing to accept. For example, if you buy a stock at 15 and set your stop loss at 13, the moment it hits 13, you automatically sell to prevent further losses. You lose 2 units per share, but at least you don't lose everything. Here's another painful scenario. You buy at 15, it rises to 19, and you sell, thinking it'll drop. But instead, it rockets to 28. You made a 4-unit profit per share, but you missed out on a potential 13-unit profit. This fear of missing out, FOMO, can drive traders crazy. There are several trading styles. Day trading, buying and selling within the same day, sometimes multiple trades in hours. Swing trading, holding positions for several days or weeks to catch price swings. Position trading, a longer approach, holding for weeks to months, riding bigger trends. You can trade various markets beyond just stocks. You can trade in forex, which involves global currencies, or in commodities like gold, silver, oil, and wheat, essential raw materials that often behave differently from stocks. And of course, there's the world of cryptocurrencies such as Bitcoin and Ethereum, and even the meme coins you constantly hear about in the digital underground. Now that you've got a clear idea of what trading actually is, let's move to the next part. Now, let's shift gears to investing. While trading is like sprinting through the neon alleys, investing is more like a marathon up to the highest spires. Investing means buying assets that you believe will grow in value and generate income over time. We're talking years, even decades. If you watched my previous show about how corporate stocks work, you might remember the story of Vera and her drone factory. That's a perfect example of what investing looks like in the real world. I'll leave the link to that data stream in the description, so you can check it out later if you want a quick refresher. When you invest, you buy a piece of a company and hold on to it as the business grows. Investors look for corporations with strong fundamentals, believing their value will increase substantially over time. Plus, many companies pay dividends. They share their profits with shareholders regularly, giving you passive income like a steady energy flow while you wait for the stock price to appreciate. Unlike hunters who obsess over flickering price charts, farmers focus on fundamental analysis. This means digging deep into a company's actual business health. Fundamental analysis focuses on understanding a company's true value and long-term potential. It involves examining financial statements like the balance sheet, income statement, and cash flow, and analyzing key metrics such as revenue growth, profit margins, earnings per share, and return on equity. It also considers the company's competitive position, management quality, business strategy, and future growth prospects to determine whether it's a strong investment. Why? Because nobody wants to invest in a failing reactor. You're looking for businesses that will thrive over the long term. Let me share an investing story from the Sky Gardens. Imagine you discover a company called Green Tech Energy that's developing innovative solar panel technology for our megastructures. After thorough research, you believe this company has massive growth potential. Their technology is superior, demand for renewable energy is rising, and they have excellent management. You decide to buy 20 shares at 25 units each, investing 500 units total. Over the next few years, Green Tech Energy launches breakthrough products that capture significant market share. They expand globally, opening manufacturing facilities in multiple countries. Their revenue triples and their profits soar. The company also pays an annual dividend of 1.50 units per share. With your 20 shares, that's 30 units yearly in passive income. The stock price fluctuates. Sometimes it drops to 20 units. Other times, it jumps to 35. But the overall trend is upward. You don't panic during the drops because you believe in the company's long-term potential. After holding for 6 years, the stock reaches 85 units per share. You decide to sell your 20 shares for 1,700 units. Your initial 500-unit investment grew to 1,700, a profit of 1,200 units. Plus, you collected 180 units in dividends over those 6 years. Total return, 1,380 units. But here's the truth about investing. It requires incredible patience. Most of Warren Buffett's wealth came after age 65, with about 99% of his wealth created after his 50th birthday. He made his first investment at just 11 years old, became a millionaire in his early 30s, but didn't become a billionaire until his mid-50s. That's decades of patient wealth building. As Buffett famously says, nobody wants to get rich slowly. Investing goes beyond individual corporate stocks. You can buy bonds, which are loans to companies or governments that pay interest. You can invest in funds that let you hold a mix of assets. Real estate offers rental income and long-term growth, while cryptocurrencies provide digital assets you can hold for the future. Now that you understand how investing works, let's move on to the next part. It's time to break down the core differences between trading and investing so you can clearly see how they compare. Time horizon is one of the biggest differences between trading and investing. Trading focuses on the short term, with positions often held for just a few hours, days, weeks, or, at most, a few months. Investing, on the other hand, is all about the long game, with assets held for years or even decades, just like the legendary Warren Buffett, who's held his Coca-Cola stock since 1988. The analysis method is another key difference. Traders rely mainly on technical analysis, focusing on price patterns, charts, and market sentiment to time their trades like a hunter waiting for the perfect strike. Investors, however, base their decisions on fundamental analysis, looking at company earnings, growth potential, and industry trends to choose strong long-term investments that will stand the test of time. Focus also separates the two approaches. In trading, the company's profitability or business model doesn't really matter. The only thing that matters is price movement and how you can profit from it in the short term. In investing, daily price swings aren't a big concern. Instead, the focus is on the company's long-term performance and growth potential. Risk and stress levels also differ significantly. Trading is generally riskier and more stressful, requiring constant monitoring of the market. Traders often use risk management tools like stop-loss orders to automatically close losing trades. And while it's possible to make thousands overnight, you could just as easily lose it all just as quickly. Investing, however, is typically more relaxed and follows a buy and hold approach. You can buy quality stocks and check on them years later, even after 5 or 10 years, as long as the company remains fundamentally strong. So which approach is better? You're probably wondering. The honest answer, it depends on several factors. Consider trading if you want potentially quick returns and can handle high risk. You have time to watch markets throughout the day. It's often like a full-time job. You're disciplined about cutting losses and taking profits. You understand that most day traders actually lose money, and you've thoroughly studied technical analysis and market psychology. Consider investing if you want steady, long-term wealth building with lower stress. You have a busy life and can't monitor markets constantly. You're patient and can resist the urge to panic during market downturns. You enjoy researching companies and understanding businesses. You think in terms of years, not days. Many successful navigators in this city actually do both. They might have 80% of their money in long-term investments for stability and use 20% for trading to potentially boost returns. This way, even if their trades go badly, their core wealth is protected. Now hold it, Sherlock. Before you put a single dollar into either trading or investing, please understand this. Without proper knowledge and skills, you're not trading or investing, you're gambling, and the house always wins against gamblers. Like I said before, always do your own research or consult with a qualified professional before making any investment decision. So that's it, a complete analysis of trading versus investing. If this broadcast was helpful to you, now is a good time to like and subscribe to me. Check out the videos I mentioned earlier, how stocks really work. Just click on the video that appears on your screen, and I'll meet you there. Exit.